how do you get to all this firing that needs to happen for the unemployment rate to climb meaningfully and cut demand? And so I wrote a script that started with the Fed's just going to keep raising rates higher for longer until there's a supply catalyst. I wrote that in July, expecting the supply catalyst to come in August, and it did. So that took us to scene 2, where bond yields start rising. And that hits equity multiples. So in scene 3, act 3, equity multiples start contracting as well. And now you have both bonds and stocks coming down. And with that, the wealth effect starts hitting modestly, because the wealth effect's a modest impact, starts hitting demand. And then you start having the negative earnings feedback, which then results in both common stock falling and earnings expectations falling. And that's when actual firings begin. So those acts have to play out before we get the Act 5, which is a recession. And I'm not sure how quickly those acts will play out, but the supply catalyst that was necessary to get them started, that transmits the quantitative tightening that the Fed is doing through Treasury issuance, started on August 1st. And I think that's the biggest deal.
On this episode of What the Finance podcast, I have the pleasure of welcoming back Andy Constan. He's the CEO and CIO of Dent Spring Advisor. So, Andy, thanks so much for coming back on the podcast today.
Anthony, it's a pleasure. Good to see you again.
Yeah, and I'm really looking forward to our conversation. A lot's happened. We were just talking before about since our last conversation, banking crises, massive sort of bull market, you could say, Nvidia going up over 100%. It's been pretty crazy. But we have recently just had the Jackson Hole Summit for the Fed. So I was wondering if you could maybe give us, an overview of it, and then your thoughts on what we saw during that meeting.
Sure. So let me wind it back a little bit to the first 6 months of the year. And in the first 6 months of the year, the debt ceiling resulted in a real dearth of new issuance of Treasury notes and bonds, duration in particular. And then this summer, we really saw continued low issuance of bonds and quite a bit of issuance of bills, which filled the TGA. And because there was this lack of supply of bonds, assets broadly, from bonds to stocks, all got bid up, and the things with the highest sensitivity to risk premium, like Nvidia and some of the big cap tech stocks, really led the market higher through this summer. And going into August, I noticed that the quarterly refunding announcement was going to be made, and that would plot the future of issuance of Treasury bonds for the next 2 quarters. And I thought that there was a fairly high possibility that the deficit would go up quite a bit, and that what had been a starvation period for almost 9 months of bonds would return with more normal bond issuance. And I was pretty aggressive at that point, saying you should be short both bonds and stocks. And that played out very rapidly in the first few weeks of August, because the Treasury, the deficit, so I was thinking the deficit would grow a lot. I was also thinking the bond issuance would grow a lot. And just to put some numbers on that, for Q3, the expected issuance was $772 billion. That had been announced the prior quarter. But only $178 billion of coupon bonds, so mostly in bills, again, to fund the growing of the return of the government's checking account, the Treasury General account. It turned out they plan on issuing over $1 trillion, still mostly in bills, in Q3. And they also announced, my estimate was $600 billion of deficit and new money that they needed, and $275 billion, which is a sizable increase from the $178 billion of coupon bonds that they issued in Q3 for Q4. And those numbers, I was by far the highest of anybody that had written anything down. And I was way low. The issuance for Q4 is going to be $852 billion, 250 higher than my high estimate. Sorry, 250. And the coupon issuance is going to be 338 billion, almost doubling the amount of issuance they had this quarter. And so that put quite a bit of pressure on bonds. And then by putting pressure on bonds, it put in pressure on multiples. And so we had a fairly sizable sell-off through to Jackson Hole, 4 or 5%. And then NVIDIA earnings seems to have the bloom is temporary, though it seems to be recovering today. The bloom was somewhat off the rose in terms of NVIDIA peaked within an hour of their earnings and hasn't seen that level since. And then Jackson Hole came in, and Jackson Hole was sort of what I expect and what I expect for the FOMC, and we'll come back to that. But we're in this period of time in which there's going to be this headwind for assets. And so what's the goal of a headwind for assets? I wrote a script, which I've posted on my Twitter feed in the highlights tab. And that script says, how do we durably eliminate inflation? And it basically operates by inflation gets eliminated permanently by a reduction in an increase in the unemployment, a significant increase in the unemployment rate, which hits demand. And so that's fairly well understood. But the problem is, how do you get to all this firing that needs to happen for the unemployment rate to climb meaningfully and cut demand? And so I wrote a script that started with the Fed's just going to keep raising rates higher for longer until there's a supply catalyst. I wrote that in July, expecting the supply catalyst to come in August, and it did. So that took us to scene 2, where bond yields start rising. And that hits equity multiples. So in scene 3, Act 3, equity multiples start contracting as well. And now you have both bonds and stocks coming down. And with that, the wealth effect starts hitting modestly, because the wealth effect's a modest impact, starts hitting demand. And then you start having the negative earnings feedback, which then results in both common stock falling and earnings expectations falling. And that's when actual firings begin. So those acts have to play out before we get the Act 5, which is a recession. And I'm not sure how quickly those acts will play out, but the supply catalyst that was necessary to get them started, that transmits the quantitative tightening that the Fed is doing through Treasury issuance, started on August 1st. And I think that's the biggest deal.
Yeah, a lot to cover there. So if we maybe go back to, it was one of the first points you mentioned, and it might be for some of the listeners who maybe aren't as knowledgeable about, I guess, fixed income and government bonds. So you're saying that there was a shortage of government bonds sort of for the first part of the year, and a lot of people would probably question that because I guess they link that to government debt and they see it all together. So can you maybe please explain that a little bit more? And,
Sure.
Yeah.
So the government stopped producing debt because they had a debt ceiling. And so they literally couldn't sell any more debt. Now, they still sold a little bit of debt and let some debt get retired. And they also used something called extraordinary measures, which is super in the weeds, that lets them issue some more debt. But the amount of debt they issued really slowed versus past quarters. So that's the first thing. The second thing is they used bills, Treasury bills. And Treasury bills are in very high demand because the yields are the highest on the yield curve. And they're like cash, so they don't carry any market risk. And bank deposits, we saw the banking crisis and some deposit flight. has great demand for bills. And there's also this program called the reverse repo program, where money market funds invest investor cash, and they only can buy bills. So Treasury bills, which are 1 year and less maturity obligations, have great depth and liquidity, and the government can fund itself very easily using Treasury bills. Treasury bonds are a different matter. Treasury bonds require people to, invest for 10 years, or if they go to sell those Treasury bonds or notes, they can experience some price change, which is not really what you expect in risk-free asset, but they carry a fair amount of price risk because interest rate changes over time. Whereas in T-bills, you just wait long enough, you get your money back. It's less than a year. And so the composition of the issuance of treasuries matters more than the amount. But in Q1 and 2, the amount was also low.
Yeah, makes sense. Thanks for explaining that. And I guess as you're saying, duration is especially more potent when there's higher volatility and inflation and interest rates and those other factors as well. So that's going to have a large impact on the assets price.
Yeah, I mean, it's generally when things are uncertain, and they always are at some level uncertain, buying any asset that has a long-term maturity is a risky venture, because you never know when you're going to need your money back. It's not risky at all in getting your money back if you wait for 10 years, but along the way, you may need money. And when you need it, you have to sell, and so you expose yourself to market risk. And that's how portfolio construction for institutional clients works as well. They're constantly balancing the amount of risk they're taking between cash and stocks and bonds. And right now, there's a relatively sudden, after a long period of time in which there were not a lot of bonds around, there's now quite a bit of bonds around. And that causes some portfolio rebalancing. Like, for instance, if bonds start cheapening and their yields start going up, people say, okay, maybe I'll buy 10-year bonds and sell my NVIDIA stock because it's had a great run. And so you see portfolio rebalancings that start occurring. And so that whole supply of bonds is transmitted into the supply of assets generally.
Makes sense. And you were saying there sort of the 1st of August, that was when the Treasury could begin again to issue bonds and bills and sort of raise capital after the debt ceiling was raised. So is that sort of what we saw?
Right. But it really, the first thing they did is they funded their bank account, which had dropped to near zero. That's actually when their bank account hits zero, that's when the government has to close down. It can still honor its debt, but it has to close down and can't spend anymore. And it came close to zero. And so the summer was about filling that bank account. And when you need money quickly, you issue the thing that everybody wants, and that's Treasury bills. And so they did that in Q3. But Q4, they're going to go back to their normal procedures, which is issuing these more risky, longer-term bonds that have a narrower demand than the bills market, and that should have an impact on assets.
Yeah, and it's close to 1 trillion that they like to have on cash, if I'm not mistaken. Or was it?
Yeah, they're going to have, I think they're planning 750 billion by year-end.
Yeah,
which is large in the context of their checking account over the last 20 years, but not particularly large over the past 3 years. It's about middle of the range for the past 3 years.
People were concerned that potentially, as you said, they're raising quite a lot of money with bills. There wouldn't be maybe the liquidity and there wouldn't be the cash available for all the demand for them. But we haven't seen that being an issue. And a lot of people have mentioned the reverse repo. So is there the possibility that the reverse repo could continue to pick up the slack moving forward for Q4, or do you think that maybe exhausted that?
It's absolutely slack. I would expect, we have part of the purpose of quantitative tightening, the reduction in the Fed's balance sheet, is to reduce some combination of the RRP program and bank reserves. And the first way of doing that was increasing the TGA which tapped some of those reserves and RRP program. And you saw that in both of those things coming down about as much as the TGA went up. But going forward, it's not really quite as big a concern, because once the TGA is built, the only pressure for the RRP and bank reserves to go down is quantitative tightening, and that only happens at about 180 billion per quarter. And we have 1.8 trillion still in the RRP, so it's 10 quarters before that even hits zero. And that leaves bank reserves still at their very high, lofty levels. So they can afford to do quantitative tightening for quite a long time. And they seem to have penciled in their in the August FOMC, or the late July FOMC, I guess, that is in fact what they intend to do, and continue to do quantitative tightening, even if they eventually cut rates. And so that brings us to Jackson Hole, I think. Jackson Hole, there are some market participants that expected a victory, a mission accomplished sort of dovish. We got inflation on the ropes and we're gonna cut. I thought that was a very unlikely outcome, and it turned out to be not what happened. And at the same time, I thought it was unlikely that he was going to say, inflation's are still a real problem and we've got to hike a lot. He didn't do either of those things. He basically said, we're working on it. We'll do it until we get it done. And then basically penciled forward the Fed projections, which are a terminal rate that is either 0 or 1 more hike between now and year end, and then modest cuts that probably will take longer than I think is penciled in for June. But he wasn't very explicit about it. He just said, we're going to pause. When we pause, it's going to be for a long time. And so the market didn't really react much, in my view, to the goings on at Jackson Hole, and shouldn't have. The only thing that did happen is 2-year notes weakened, because they had already priced in about 140 basis points of cuts, and it doesn't look like that's going to be realized until today. And today we had a JOLTS number, which is the number of people looking for work. The amount of companies that are looking for people to fill jobs fell. And so we have a very large bond market rally, stock market rally, everything rally this morning, because there's an expectation that once again that we achieve a soft landing, where jobs, the job market slackens, reducing inflation pressure, and the Fed can stop hiking and maybe cut. And so that's caused everything to rally, and we'll see if tomorrow's jobless claim numbers, the NFP, we're talking about 1% moves here, 1-2% moves here, confirm or contrast with the numbers we saw today. But that's the normal noise through FOMC in September, when we actually hear what the Fed thinks their path is going to be for next year.
Do you believe that, I guess from employment, that it will, as you said, start to continue to slow down? People looking for, you said the jobs there, but even then, unemployment, new people, applying for benefits. Do you think that's going to slowly start to increase?
So I think, as I said at the beginning, it's going to take a series of events to cause massive reduction in demand for jobs. Modest demand reduction in jobs, sure, that could swing back and forth. There's still, this fiscal deficit is still highly stimulative and growing. And so that's a concern if you are thinking the economy is going to roll over with the government spending, $1.6 trillion more than they tax. It's hard to believe we're going to roll over hard. given that event. But for it to roll over, I think first you have to have financial conditions tightened by stock markets and bond markets falling, reducing demand, because wage demand, even if it eases a little bit, there still are more workers than there more workers than is likely to cause a demand reduction. In fact, it's more likely to cause continued increased demand and thus higher inflation. So I'm thinking that, we're still in this period where inflation is going to be with us for a while and needs more mechanisms that lead to job loss to ultimately kill it.
So I know there's been lots of talk, I guess, about student debt, I think, in the US and how they're going to, a few people are going to have to start repaying back their student loans. So do you think something like that could have a, I guess, beneficial impact on inflation, where there's going to be less money obviously circling around the economy because people need to pay these bills?
Yeah, I mean, most the availability of money and credit is still very easy. And so while interest rates are a little more expensive, credit is very available. And so I don't think you're going to find a credit crisis or a credit crunch causing people to stop spending and start paying off their debt. That typically happens when they lose their jobs, and people aren't losing their jobs.
Does that need to happen, or could there just be, as you mentioned there, sort of slow increase in unemployment, and I guess a slow increase in all these factors? Or do you think there needs to be that catalyst?
Anything can happen. It just doesn't typically happen that way. That there tends to be either central bank policy or fiscal policy that, or an exogenous event, of course, which we can never predict, that tends to cause significant shifts in hiring trends.
Makes sense. So then you've still got, you mentioned in August, you were short everything again. And I'm guessing you still think that's going to be the play for the rest of the year.
Well, I'm short bonds and stocks. I'm not short gold or commodities. And tips are okay as well. They carry inflation-linked bonds, carry a low break-even inflation relative to target, and a substantial real yield. So I'm not short those. Sometimes I do short those when I think all assets are bid up. Right now, I'm just short stocks and bonds, and giving back a little bit today, but still quite happy with that position, because I do believe that regardless of whether we're in a recession or in a continued expansion, that financial conditions are likely to tighten.
Yeah, makes sense. So what would have to change for you to maybe change your mind on this?
Well, that would depend. There's a variety of ways things could change. So, for instance, I wouldn't be short-term bonds if I thought a recession was coming imminently. In fact, I'm not. I had been short when last time we talked. I was short 2-year notes. I covered those about a month ago, and now I'm looking to buy them because they are so much richer than they were. Sorry, not richer, cheaper from a standpoint, higher coupon. So cheaper to buy than they've been for a while. I'm not right there yet, but at some level, I think that's going to be a good investment to be levered long 2-year bonds. But I'm short long-term bonds because I think of the supply catalyst is going to keep a fairly strong headwind, and those are nowhere near as cheap as short-term bonds are at this stage. And of course, if the economy continues to roar, or the central banks decide to give up or raise their give up on inflation or raise their inflation target, then you have to be long stocks and gold, and you just have to be short bonds. So it'll depend on how things. So I'm very open to change. The ideal way that things could work out is that things follow my script. Assets, bonds and stocks both fall. I cover them, and then we have an expansion. But right now my bet is that bonds and stocks will underperform cash, and that won't last forever. But hopefully when it does, I can shift my view. But in terms of the question you asked, basically if a recession came in much quicker than I expected, or if the central banks gave up on inflation, I'd have radically different asset allocations.
Yeah, because I think a lot of people have thought that we potentially could see there will be a catalyst. It'll be like a 2008 where just everything falls apart quite quickly. And then, yeah, it sounds like sort of your positions maybe, especially I guess the short bond might struggle in that
Yeah, no,
situation.
and
No.
that's an important thing. I think a lot of people are looking for parallels to prior events, and I think the biggest mistake people are making is thinking that we're in a expansionary phase that, due to central bank tightening, credit breaks, which is what we saw in 2007, 2000, 1990 a little bit, certainly. Over the years, when you've seen credit events, COVID, obviously, a little bit at some level, where you saw some sort of exogenous event in which people were all of a sudden unable to pay back money they owed. That's not what we have here. We have a situation where everybody's got money and is capable of paying it back. And that's why we have inflation. And an inflationary cycle that's built on wages and built on demand doesn't get destroyed the same way and doesn't have the same reaction that in the bond market went to a sort of a credit crisis, in which everyone who is owed money prefers to own treasury bonds than the corporate or mortgage or consumer debt that they own.
Yeah, and I guess sort of the situation that we're probably thinking of now, what I was sort of mentioning before, would probably be more almost like a K recession, I guess, if you invert it. So probably the people, yeah, lower demographics would be hit the worst around employment, but potentially similar to, I guess, COVID and the boom that we had after that. That was all the high earners spending, and they might not be as affected during such a scenario.
Yep.
And then if we go sort of overseas, is that do you think there's going to be similar trends in sort of other markets, I guess Europe, UK, Asia, or do you
Well,
think they're a little
each of
different?
those regions are in a different part of the cycle. The east of the United States, Asia, is has not really stimulated and is in the sort of the post-COVID sort of weak period that you didn't get because you didn't get an adequate stimulus, and they may need stimulus, which would have a different impact on assets than Europe, which is ahead of us in terms of already seeing negative GDP growth, but still very high inflation. And so they're just in a different portion of the cycle than we are, with different specific issues, but common frameworks. And so, broadly, that would mean, and this has been a great trade for me and has gone a long way already, but weak Asian currencies, strong European currencies, and a middling dollar is consistent with those different periods of the cycle.
Do you see that continuing, or do you see? I know dollars started to strengthen recently. Do you think that would
I'm
continue?
finding, the Asian thing, I think, is got a long way to go. Both the yen and the yuan and even the Aussie dollar have, I think, have quite a bit more on the downside. Europe versus the US, it's touch and go. I don't have a strong view. I do think that pound, which saw a lot of capital flight when in October, when you had the LDI crisis, that was panic, get me out of the UK, has rapidly recovered and is now, from a fundamental standpoint, fairly rich relative to other currencies, and I think probably a good short relative to dollar or euro, but investors just don't own a bunch of it. it's not an overweight in people's portfolios. So because it's an underweight, there's this sort of underlying bid for it if it were to come in. So I'm looking at that as a possibility, but the fundamentals probably are the economy that's in the most difficult shape to me in the Western world is the UK.
Yeah, it makes sense. And I guess if we sort of link what happened in the UK with the pension issues there, could you see, and I guess it's sort of linked a little bit to banks in the US and what happened in March and how
Sure.
a lot of them struggle for liquidity. Could you see something like that continuing to occur if we see what you suggest, and I guess bonds and bills that they continue to depreciate?
Yeah, so we saw some of the most aggressive banks in the country betting on falling interest rates with depositors' money, and that went poorly. Um, we haven't heard much since, which tells me there are some lurking that have possible downside, but not much because the regulators are crawling up every one of their proverbial bums to find out where things are bad. Um, and regulation is coming that will both limit the risk taking of these banks and protect their depositors so their depositors don't run. That's a bureaucratic process, but I don't see a imminent crisis recurring in what is by owning treasury bonds in a levered way and having that not work out. There is there's a very well-known unknown black swan, probably the most popular black swan, so much that it's hardly even a gray swan. That is commercial office space credit that is owned by a bunch of banks, but also owned by others. Um, and I think everyone knows about it, and people are preparing for it. And will they have prepared adequately? We'll see. Somebody won't have, but will it be a global financial crisis like contagion? I don't see that as a likely outcome at all.
Yeah, makes sense. So, Andy, thanks so much for your time today. I really appreciate it. My last question is, what is one message you'd like people to take away from our conversation?
Yeah, sure. So, we don't know whether the economy is going to plunge into recession anytime soon. That should generally support earnings, but earnings are already fairly aggressively priced in terms of analyst expectations. And so you have to wonder whether you can get a bond market that expects recession and a stock market that expects 12% earnings growth year over year. And so you have to be careful about owning both of those things. You can make a bet saying we're going to have a robust economy, and in that case, own stocks, or you can make a bet if you say we're going to go into a recession, and then you can own bonds. But you really can't own both because one or the other of them is going to really do badly. And so my view is it's better to be short both and have money in cash than it is to choose. But it's a coin flip on which way we go in the near term.
Yeah, and I guess it's changing the 40 years of opinion that you can be long both and benefit.
Yeah. Yeah. Yep.
Yep. So, yep, Andy, thanks again. So if anyone wanted to find out more about your work, I know we mentioned Twitter. Would that be the best place? Is there
Yeah.
anywhere
Damp
else?
Spring at Damp Spring is my Twitter handle, and dampspring.com is my website.
Perfect. I'll put that in the description below, but thanks again for your time.
All right. Thanks, Anthony. See you later.
Thank you so much for listening. And if you enjoyed the episode, please subscribe and click the bell icon so you are notified when new podcasts are released. I hope you're leaving with some great value about investing, trading, and finance. See you on the next show.